And back on a Tuesday morning, behind-the-scenes interview time here on the Farm Hour. Our guest in studio joining us, as he does most Tuesdays throughout the month, Rory Lewandowski from the OSU Extension Office here in Wayne County. And today we are continuing our discussion from last week on core farm financial documents. In last week's program, we discussed balance sheets. Today, we're going to discuss farm income and cash flow statements. So begin by giving us, Rory, a brief overview of the farm income statement and cash flow statement. What information does each provide? How do they differ?
Okay. Well, a farm income statement measures profitability over time. It's sometimes called a profit and loss statement. One of the key numbers produced by that farm income statement is the net farm income figure. The cash flow statement explains how money moves in and out of the farm business. The cash flow statement will tell you sources of income. It allows you to look at the different kinds of expenses that you're incurring on your farm operation.
Let's begin with some discussion about the farm income statement. Farmers need to fill out a Schedule F form as part of their income tax filing obligation. Doesn't that document provide a picture of farm income, or is it not enough?
Yeah, that's a very common question, but really farm profitability or loss as reflected on your tax forms is not the best measure of farm profitability within a calendar year. And also you have to think about that your goal in filling out an income tax form is really different than from doing a financial analysis of farm profitability. Another factor is that the tax system is a cash basis accounting system, while really a more accurate measure of farm profitability, a truer picture, uses accrual accounting. So under accrual accounting, farm income is reported when it's earned as compared to when it's received, and farm expenses are then matched with corresponding income transactions, or they're reported when they occur, not when that cash is actually paid. So the accrual system really better reflects the complexity of many of our farm business transactions, and oftentimes that lag time that occurs between a transaction and then the actual cash movement. So that's what's used in putting together that farm income statement.
Rory, how is farm income measured in the farm income statement, and what kind of accrual inventory adjustments are accounted for in that?
Yeah, that's a good question. So our typical farm cash receipts include things like sales of livestock, grain for the dairy farmer, obviously milk, forages, or any other farm-produced products, plus any other sources of income. So it could be rent, if you're renting out land or buildings, something like that. Maybe you're doing some custom work, government payments, or any other kind of miscellaneous farm income. Now, measuring changes in inventories is dependent, obviously, upon good record keeping. So all of these financial statements go back to good record keeping. So you have to have good record keeping, accurate beginning and ending balance sheets. So that kind of ties in our topic from last week. Those inventories then represent products that are produced, such as livestock and crops that have yet not been sold, but they represent cash or could be turned into cash. Now, if the inventory value of those crops and livestock and cash receivable is greater at the end of your period as compared to the beginning of the period, usually we're talking a calendar year, then that increase in value needs to be added to cash farm receipts. If the value is less, then the decrease is subtracted from cash farm receipts.
The other half of the income statement is farm expenses. What kind of adjustments are made to accurately reflect farm business expenses?
Well, on that side, on the expense side, inventory or accrual adjustments represent expenses that are incurred during that reporting period, again, that calendar year, but maybe not be paid until later. Some examples. I've got a loan and I'm accruing interest. It's that interest is been incurred during the year, but I'm not going to pay it until later. It could be farm taxes. Accounts payable. For example, I purchase feed or some supplies on credit. I've incurred that expense, but I'm not actually going to move cash until later. If the ending reporting period value of those expenses is greater than the beginning value, then this is going to increase total cash expense. If, on the other hand, that ending value is less than the beginning value, then total cash expense will be decreased by that difference. So some examples of inventory adjustments that have to be made include the difference in beginning and ending value of the investment in growing crops, commercial feed, supplies, and any other prepaid expenses.
Once again, our guest in studio today from the OSU Extension Office, Rory Lewandowski, here on the Farm Hour. what about depreciation, Rory? What is, or I should say, that is an important tax expense on most farms, if not all of them. Is it part of the farm income statement as well?
Yeah, that's a good question. So depreciation on farm income statements is usually different from depreciation expense claimed on farm taxes. Again, for farm tax purposes, oftentimes we're trying to maybe take an accelerated depreciation, depreciating as much as possible to reduce a tax burden. The depreciation figure used on a farm income statement, though, should really represent the actual decline in the value of machinery, equipment, buildings, and any other capital assets that are due to use, kind of that wear and tear and obsolescence. So it's usually a little bit slower schedule. So for an example, here in Ohio, as we work with farm owners and managers, we have typically used a depreciation rate of 5% for buildings, 7% for machinery and equipment, and then 15% for titled farm vehicles.
Rory, how can the farm use the information from the farm income statement? You know, what kind of questions are asked and answered when you've got this information?
Yeah, well, the purpose of the farm income statement is to help the farm manager or farm owner measure farm profitability over time. So again, getting that comparison, which direction is my farm moving? So it's good to have that information certainly from a single year's farm income statement, but it's really better to examine the trend over time to get a more comprehensive view of how that farm is performing, because anyone can have one good year or one bad year, but what's that trend over time? Where's that farm going? So to do this, compare the current year's income statement to past years. Look at the income and expense categories and spend some time analyzing them in a little more depth. What are areas of high expense traditionally from year to year? Where is the least amount of money spent? Do those categories change between years? Are there management practices that could be utilized to help improve profitability? So that farm income statement, along with the farm balance sheet, can be used to calculate a return on farm assets as well as a return to farm equity.
Moving on now to the cash flow statement. Rory, can you explain how that document is put together?
Yeah, so it's a little bit different. The cash flow statement lists all the cash inflows to the farm operation through the year. So that'll include things like livestock and livestock product sales. So, for the dairy farmer, it's your milk sales, plus any other capital sales, government payments, crop sales, non-farm income, anything that's, again, coming in as income to the farm. Expenses then are withdrawals from the farm business. They include things like seed, fertilizer, feed, supplies, all those expenses that are involved in operating the farm business, plus capital purchases like additional or new machinery and equipment, loan principal payments, and interest expense. Oftentimes we see cash flow statements put together maybe for each month or perhaps each quarter.
Rory, why is the cash flow statement important? And second part of the question, how is it used specifically?
Okay. Well, the cash flow statement's important because it shows liquidity. Liquidity is the ability of the farm business to meet expenses in a timely manner. So when a cash flow statement is put together to show income and expenses on a monthly basis, it's very useful. It can help a farm make decisions about the timing of certain financial transactions. It can help identify cash deficit periods, maybe allow the farm then to make plans to make some corrective action, maybe shift some things around. The cash flow statement can also be used to make cash flow projections, and in tough economic times, this definitely can be used to develop plans to improve farm liquidity through maybe sales of some assets, generation of additional income, reduction in certain expenses, or possibly to restructure debt.
Rory, finally, we have covered two financial documents very briefly and could obviously spend a lot more time on this topic. Where can somebody get more information about putting farm income and cash flow statements together? And also, if they want to re-listen to this, how can they do that?
Okay. Again, they can contact me at the Wayne County Extension Office at 330-264-8722. Right, this is a complex topic. We can provide more information. And then, as you've mentioned, Again, WQKT is graciously providing us with files of these interviews so people can go back and listen. We'll be posting them on the Wayne County Extension website at wayne.osu.edu. Click on the Agriculture and Natural Resources tab.
All right. Rory Lewandowski joining us again in studio today from the OSU Extension Office here in Wayne County. Rory, as always, appreciate the time. Thanks again for the great information and look forward to seeing you next time around.
You're welcome. Thanks, Ron.